Welcome to the Deep Dive. Today, we are really immersing ourselves in the world of high-stakes risk management. We're focusing on a company that's, well, arguably one of the most formidable players out there, RenaissanceRe Holdings Ltd. You probably know them as RNR.
Yeah, RNR. They're a premier global property and casualty reinsurer.
Yeah.
Basically, they insure the insurance companies.
Exactly. But this isn't just, your standard reinsurance story. We're diving in right now because RNR is at a really interesting point. They just completed this truly transformative acquisition. It's really boosted their scale and kind of shifted their strategic position.
It really has. And that makes this deep dive, well, pretty critical right now. R&R is navigating this period of, let's say, maximum opportunity, but also, maximum exposure. We really need to unpack the fundamental strength of their model against the inherent risks they take on. And those risks are definitely escalating.
Okay, so there's a core tension here.
Oh, definitely. It's stark. On one side, you've got a business model that just, well, outperforms. Simple as that. R&R reported a record operating return on equity ROE of 23.5% in fiscal year 2024. That's huge.
23.5%. Wow.
And their tangible book value per share, plus the dividends they paid out, grew by an astonishing 26.0%.
26% growth in book value plus dividends.
Yeah. These numbers put them right at the top of their peer group. And remember, they achieved this in a year where global insured catastrophe losses went past, like, $140 billion.
Okay, so that's the impressive side. Superior profitability, even in a tough year.
That's the, let's call it, the easier part of the story to grasp.
Right, so the challenging part, the tension you mentioned, must be the risk profile.
Exactly. Their portfolio holds significant exposure to two very large and interesting, largely uncorrelated macro risks, and both seem to be getting more intense.
Okay, what are they?
Well, first, there's their historical concentration in high-severity property catastrophe risk. Think hurricanes, earthquakes, wildfires. And that risk is being amplified, complicated, made less predictable, frankly, by climate change.
Okay, that's risk one, climate-driven property cat risk.
Right. Second, because of this recent big acquisition, they now have massive exposure to the headwind of U.S. social inflation.
Social inflation. We hear that term a lot. What does it mean in this context?
It's basically the rising cost of insurance claims, particularly in liability lines driven by societal trends like bigger jury awards, more litigation. It makes it really hard to predict and reserve for long-tail casualty claims, things like general liability.
So two big evolving risks. Climate change hitting property, social inflation hitting casualty.
Got it in one.
So our mission today, then, is to look past those flashy headline numbers, that great ROE, and try to figure out if the market is valuing RNR correctly. Because right now, it trades at a discount compared to some peers, probably because investors are wary of that catastrophe exposure.
That seems to be the market's view, yes.
So the big question: does the resilience and the durability of their newer, more diversified earnings model, what R&R themselves call their three-legged stool, actually justify a higher valuation? Or do these compounded macro risks, climate and social inflation, kind of cancel out that superior profitability?
That's the core question we need to wrestle with. Let's unpack this machine.
Okay, so to really get R&R's performance, we need to understand how they actually make money. The architecture of their profitability. Their core philosophy isn't just about writing any risk, right? It's about being the best underwriter.
That's their mantra. And how they do it is by meticulously matching desirable risk with efficient capital. It sounds a bit like jargon, but it's key.
And they operationalize this idea through three distinct profit drivers. These aren't just separate businesses. They're designed to work together, right? Mutually reinforcing.
Exactly. You look at a lot of traditional reinsurers, they might rely heavily on underwriting profit, maybe some investment income. R&R built this ecosystem where the parts feed each other. It's often called the three-legged stool.
Okay, let's break down the legs. Leg number one.
Driver one, core underwriting income. This is the foundation, the bread and butter. It's the profit they make from actually insuring the risk itself, across both their property and casualty segments. This is where their expertise, their intellectual capital, really comes into play.
And how big is this like?
In fiscal year 2024, even with those huge catastrophe hits we mentioned, this generated a pretty substantial $1.6 billion in income.
Okay, $1.6 billion from underwriting.
Yeah, it's the engine driving the whole thing. But, as we've already established, it's also inherently the most volatile part. Big swings are possible.
Right, underwriting income is leg one. Volatile, but core. What's leg two?
Okay, let's actually jump to leg 3 first because it connects nicely to managing that volatility. Driver 3 is investment income.
Ah, the float.
Precisely. This is where the sheer size and, importantly, the duration of their liabilities become a real asset.
Explain the float concept quickly for us.
Sure, when R&R writes an insurance policy, especially a casualty policy, they collect the premium up front. But they might not have to pay out a claim related to that policy for years, maybe even decades later. That pool of money they hold in the meantime, the reserves set aside for future claims, that's the float. And they get to invest that float.
And in the current interest rate environment, that float has become incredibly powerful.
Oh, absolutely. A powerhouse is the right word. In 2024, this driver delivered an incredible $1.7 billion in income.
Wait, $1.7 billion. That's more than the underwriting income.
Exactly. It actually surpassed the core underwriting income. And what's fascinating here, and maybe something investors sometimes overlook, is the impact of this higher for longer interest rate environment we're in. Higher rates mean higher returns on that massive float. This investment income acts as a stabilizing ballast. It's consistent, high-quality income that provides a crucial cushion against those sharp swings you inevitably see in the property segment.
So the float from the insurance operations fuels the investment engine, which then smooths out the bumps from the insurance operations, particularly the cat-heavy property side.
You got it. And the sheer size of this investment portfolio, which got a lot bigger with the Validus acquisition, is now a really critical part of their overall risk management strategy. It's not just a side benefit anymore.
Okay, so we have underwriting expertise, driver 1, and investment stability from the float, driver 3. What's the third leg, the one we skipped?
Right. Driver 2 is fee income, and this is generated through their Capital Partners platform. This is arguably the most unique element, the part that truly differentiates RNR.
Capital Partners. What's that involve?
Okay, so this is where R&R essentially takes its core competence, its superior underwriting skill and risk modeling, and turns it into a product they sell to external investors. They manage third-party capital, think pension funds, sovereign wealth funds, other big institutions. They manage this money through specialized vehicles, often called insurance-linked securities or ILS vehicles.
Can you give examples?
Sure. Names you might hear are DaVinci that primarily takes proportional shares of R&R's catastrophe risk, or the Medici Fund, which focuses on higher yield reinsurance opportunities. Vermeer and Fontana are others.
So these external investors basically pay R&R to pick the risks for them, using R&R's expertise and market access.
Precisely. They want R&R's analytical edge and their ability to get onto the best reinsurance programs. In return, R&R earns fees.
What kind of fees?
Typically, it's stable management fees, maybe 1–2% of the assets they manage for these partners, and then performance fees, often around 20% of the profits generated, assuming they clear certain performance hurdles.
And how significant is this fee income stream?
It generated $327 million in 2024, which is quite substantial for what is essentially a fee-based business with relatively low capital requirements for R&R itself. But the real beauty here is what they call the hybrid model. R&R doesn't just manage other people's money, they co-invest significantly alongside their partners.
So they have skin in the game.
Exactly. R&R puts about $1.5 billion of its own capital into these vehicles, alongside a huge $13.5 billion of partner capital.
$1.5 billion alongside $13.5 billion. That's serious alignment.
It achieves perfect alignment of interest. If R&R's underwriting or models are off, R&R loses money right alongside its partners. But the upside is huge. It allows R&R to offer massive capacity to its clients, far more than its own balance sheet could support alone, without needing R&R shareholders to put up all that capital themselves.
That's the key, isn't it? Leveraging third-party capital lets them punch above their weight in terms of capacity and market influence without diluting their own shareholders excessively.
It's the definition of capital efficiency, and management is pretty clear about its value. They estimate this platform adds roughly 3 percentage points to the firm's annual ROE.
3 extra points of ROE.
Without needing any additional shareholder capital, it's basically ROE growth fueled by their brains and financial structuring, not just by putting more equity dollars at risk.
Okay, let's quickly tie the 3 legs together. The synergy.
Right. It's a closed loop, really. The underwriting expertise and the proprietary models used in the property segment, driver 1, are essentially the product that the Capital Partners platform, driver 2, sells to generate those high-margin, low-capital fees.
Okay, underwriting feeds fees.
Meanwhile, The growing casualty segment, especially post-Validus, provides the stable, long-duration loss reserves. That's the float that fuels driver 3, the investment income.
Right. Casualty fuels float, float fuels investments.
And that consistent investment income, driver 3, helps stabilize the inevitable earnings volatility that comes from the high-risk, high-reward property segment, driver 1.
So it all connects. Property provides the core risk expertise. Casualty provides the stable float. Capital Partners leverages the expertise for fees. And the investment income from the float smooths everything out.
That's the ecosystem R&R has built. It's designed to be self-reinforcing.
Okay, now we need to dig into the two main underwriting segments themselves because they really define the risks R&R has to manage day to day. Let's start with their historical roots. The engine of volatility, but also high margins. The property segment.
Yeah, R&R was essentially born out of the ashes of Hurricane Andrew back in the early 90s. They were pioneers in scientifically modeling and pricing catastrophe risk when others were running scared. So this segment, their traditional core, focuses almost exclusively on high-severity, infrequent risk. Big, bad events.
What kind of contracts are we talking about mainly?
Primarily excessive loss reinsurance. Let me explain that for the listeners. This means R&R doesn't pay for the smaller, more frequent claims an insurance company might have. Instead, R&R only steps in when the client's loss could be tens or even hundreds of millions of dollars. They cover the really big tail risk.
So high premiums for that protection, but potentially huge payouts when disaster strikes, extreme volatility.
Exactly, and this segment accounted for about 41% of their total gross premiums written, GPW, in FY 2024, which came out to around $4.8 billion, still a very significant chunk of the business.
And you mentioned the numbers really show this volatility. You had a couple of stark examples.
Yeah, look at the fourth quarter of 2024. The property segment reported a very strong combined ratio of 71.6%. Now remember, a combined ratio below 100% means you're making an underwriting profit. So 71.6% is excellent.
71.6, very profitable.
But here's the kicker. That 71.6% was achieved after they absorbed a massive hit, a 41.8 percentage point impact on the ratio from Hurricane Milton.
Wow. So without Milton, their combined ratio would have been incredibly low, like under 30%.
Phenomenally low. It shows just how profitable their underlying book of business was at that point in the cycle.
Okay, that's the upside. Now show us the other side of the coin.
Flip to Q1 2025. This is the stress test. The combined ratio in property spiked dramatically to 148.7%.
148.7%. Ouch.
Yeah, that was after taking a massive 113.5 percentage point hit from the California wildfires that quarter.
Let's pause on that 148.7% number. What does that actually mean in plain English? If you're an investor seeing that, what should you understand?
It means that during that specific quarter, for every dollar of premium R&R earned in its property segment, it paid out roughly under 49 cents in claims and related expenses.
So a significant underwriting loss for that period in that segment.
A staggering temporary underwriting loss, yes. These are the kind of earnings swings, the tail risk hitting the bottom line that you implicitly accept when you choose to specialize in high-severity risk. R&R knows these quarters can happen. The whole game is having the capital structure and the other income streams to absorb them and keep going.
And R&R strategy isn't to run away when these losses hit, is it? They're known for being opportunistic.
Exactly. They are counter-cyclical players. When the market gets hard, meaning rates shoot up because capital has fled the market after major losses, R&R actually leans in. They did precisely this during the mid-year 2025 renewals. After a period of heavy losses for the industry, they used their strong capital position and analytics to actually construct their largest ever net retained property catastrophe portfolio.
So they increased their exposure when others were pulling back.
Yes, because they believe their proprietary analytics, their REMS system, allows them to price that risk more accurately than the competition even, or perhaps especially when recent losses make the future look scary. They see opportunity in dislocation.
Okay, that's the property segment. High risk, high reward, volatile, but where R&R has deep expertise. Now let's pivot to the other big piece, the segment designed to be the counterweight, the stabilizer, casualty and specialty, CNS. This is really the segment that defines the new R&R, post-Validus.
Absolutely. The acquisition of RenaissanceRe from AIG, that was a deliberate strategic move to rebalance the company. And it worked. CNS is now their largest segment by premium volume. It accounts for 59% of their total GPW in FY 2024. That's about $6.9 billion. This represents a fundamental shift towards diversification and hopefully more stable earnings.
And the risk profile here is different from property.
Very different. We're talking longer duration risks here. Think lines like general liability, professional liability, like errors and omissions for doctors or lawyers, marine insurance, some credit risk, and critically, it's written primarily on a proportional basis.
Proportional basis, so the opposite of excessive loss.
Exactly. In proportional reinsurance, R&R agrees to take a fixed percentage, say 20%, of the primary insurer's premiums and losses on a specific book of business. They share the fortunes, good and bad, proportionally.
So the underwriting margins are likely thinner than in property cat.
Generally, yes. But the cash flow is much steadier, much more predictable. There isn't usually that same massive single-event loss potential.
So the main strategic contribution here isn't necessarily huge underwriting profits, but more about that stability and, crucially, generating the float for the investment engine.
Precisely. This CNS segment generates massive amounts of long-duration float. Because claims in lines like general liability can take many, many years to be reported and ultimately paid out. If you look at their balance sheet, it tells the story. They have something like $19 billion in net reserves money set aside for future claims against only about $10 billion in common equity supporting the whole company.
$19 billion in reserves versus $10 billion in equity. That's nearly 2-to-1 leverage on the investment side.
It's significant investment leverage, yes. Every dollar of shareholder equity is effectively backing almost $2 of invested assets, all throwing off that investment income we talked about earlier, driver 3. That's the stabilizing power of the CNS book.
Okay, but this staple float generator isn't without its own unique risks. You mentioned U.S. social inflation. This sounds less tangible than a hurricane, more creeping.
It is. And it's the risk that probably keeps casualty actuaries up at night more than anything else right now. Social inflation refers to the rising cost of claims, not because there are more accidents necessarily, but because of shifts in society, the legal system, jury behavior.
What drives it specifically? Give us some examples.
Well, a big driver is the rise of so-called nuclear verdicts. These are jury awards, especially in liability cases, that exceed $10 million, sometimes vastly more. We're also seeing increased activity from litigation funders, third parties who finance lawsuits in exchange for a share of the settlement, which can encourage plaintiffs to hold out for larger sums and drag cases out longer. And alongside that, there seems to be a broadening definition of corporate liability and responsibility in the eyes of jurors and judges.
And this hits certain lines harder than others.
It disproportionately affects U.S. general liability and some professional liability lines. And the big problem it creates for insurers like R&R is uncertainty in setting reserves. How much money do you need to set aside today for a claim that might emerge 5 years from now and not be settled for 10 or 15 years, especially when the potential payout is being influenced by these unpredictable social and legal trends?
So if they underestimate today, they have to boost reserves later, which takes a bite out of future earnings.
Exactly. It's called adverse development, and it's a major concern across the casualty insurance world.
So R&R can't just plug this into their fancy REMS catastrophe model like they do for a hurricane. This requires a different approach.
Absolutely. This isn't primarily a physical science modeling problem. It's a social science, legal, and economic one. It demands constant vigilance, active portfolio management, and judgment, not just a model update.
And how has R&R responded? Have they acknowledged this risk?
Oh, very proactively. Management has been quite public about identifying U.S. general liability as an area where profitability was challenged by these trends. Over the past year or so, they took significant action. They actually reduced their exposure, their writings, in U.S. general liability by about 30%. Just cut back the amount of business they were doing there.
30% reduction. That's a big move.
It is. And simultaneously, for the business they kept, they implemented substantial rate increases, trying to get ahead of those rising loss costs. It shows discipline, surgical underwriting, trimming the parts of the stability engine that were showing signs of strain.
Okay, let's bring this back to performance. We mentioned 2024 was a record year, that 23.5% operating ROE, even with $140 billion in global insured cat losses. A lot of that success seems tied to the timing and execution of that big Validus acquisition.
The timing on the Validus deal was frankly brilliant, or maybe just very fortunate, but likely a bit of both. It closed in November 2023.
Why was that timing so critical?
Because it was just before the massive January 1st reinsurance renewal season. Most reinsurance contracts globally renew on Jan 1. Closing in November meant RNR could immediately deploy its newly expanded capital base, its broadened client relationships from Validus, and its combined expertise right into those crucial negotiations. They maximized the benefit, capturing peak cycle pricing while the market was still very favorable for reinsurers.
So they hit the ground running with the combined entity right when prices were highest.
Exactly. And by all accounts, management executed the integration incredibly well. They described it as an outstanding success. Critically, they managed to retain virtually all of the Validus reinsurance portfolio they wanted to keep. It wasn't just buying assets, it was integrating a whole book of business successfully.
And it fundamentally reshaped their business mix, as you said, boosting C&S to nearly 60% of their premiums.
Correct. It demonstrated that the acquisition wasn't just about getting bigger. It was about strategically rebalancing the sources of risk and profit.
And there was a financial kicker, too. Something about capital efficiencies.
Yes, that was a key synergy. When they combined the two companies, they found they needed less overall capital backing the combined entity than the two separate companies needed. This is due to diversification benefits the risks from the R&R book, and the Validus book weren't perfectly correlated.
So combining them reduced the total risk profile, freeing up capital.
Precisely. They unlocked significant capital efficiencies.
And what did they do with that freed up capital? Did they just sit on it?
No, they put it to work immediately. They deployed it into a very aggressive share repurchase program.
Buying back their own stock. Why is that significant?
It's a powerful signal. Management is essentially telling the market, we've unlocked this extra capital, and we believe the best return we can get on it right now is by buying our own shares, because we think they're undervalued. It reinforces the idea that they see a disconnect between the intrinsic value and the current market price.
Okay, so the Validus deal was well-timed, well-executed, strategically important, and unlocked capital for buybacks. But the real test, the proof that this whole integrated three-legged stool model actually works under pressure, came shortly after, right? With that big Q1 2025 loss from the California wildfires.
That was the crucible, the definitive stress test for the newly configured RNR. The headline numbers look pretty scary. As we mentioned, a net negative impact of $702.8 million just from large losses in that quarter. That drove the consolidated combined ratio for the whole company up to 128.3%. and resulted in an overall underwriting loss of $771 million for the quarter.
$771 million underwriting loss. In a more traditional, catastrophe-focused reinsurer, what would that likely have done?
Oh, that kind of hit could easily have wiped out a significant chunk of quarterly earnings, maybe even led to a notable drop in book value per share. In some cases, it might even prompt questions about needing to raise more capital.
But that's not what happened at R&R. The diversified model held up. How did it work?
This is the absolute core insight, the proof of concept. The integrated model provided an almost perfect offset. In that very same challenging quarter, R&R's massive investment portfolio driver 3, remember, largely funded by the float from the now bigger C&S segment, generated $738 million in total investment results.
Wow. So an underwriting loss of $771 million, but investment gains of $738 million.
Almost dollar-for-dollar offset. The resilience was immediate, tangible, and directly attributable to the diversified model. The investment income acted exactly as the stabilizing ballast it was designed to be.
So why didn't the market immediately cheer this resilience? If the investment income basically canceled out a massive cat loss, did the stock price reflect that?
Not really, not immediately. The market seemed to fixate on the big headline underwriting loss, that 128.3% combined ratio. That spooked investors and led to some short-term weakness in the stock price.
Suggesting the market was still viewing R&R through the old lens, still applying that volatility discount for property cat risk.
It certainly seems that way. But if you look past the headline loss to the ultimate outcome for shareholders' equity, the story is different. Despite absorbing that huge catastrophe loss, the company actually protected its tangible book value per share. In fact, it even grew slightly by 0.9% in the quarter.
Okay, growing book value even slightly in a quarter with a $700 million plus cat loss is pretty remarkable.
It's the data point that speaks volumes. It demonstrates the model functioning exactly as intended. The volatile swings from catastrophe risk, property, are now being effectively cushioned by the stable, growing returns from the investment portfolio, float investments, which in turn is funded by the large, stable C&S segment. The system worked under extreme stress.
The three-legged stool held up.
It did. And just to underscore that the Q1 loss was an event, not a fundamental breakdown, the recovery was swift and strong. In the very next quarter, Q2 2025, RNR reported an annualized operating ROE back up to 24.2% and a healthy combined ratio of 75.1%.
So sharp rebound.
Demonstrating strong through-cycle execution. It reinforces the narrative that major cat losses, while painful in the moment, are now manageable bumps in the road for R&R, not existential threats that derail the whole company. Hashtag V. Industry dynamics and competitive moat.
Okay, let's zoom out a bit now and look at the broader landscape. R&R doesn't operate in a vacuum. What's happening in the overall reinsurance market right now? You mentioned it's softening.
Yes, the market is definitely transitioning. We came off a period of very hard market conditions, meaning high prices, tight terms and conditions, largely driven by several years of heavy catastrophe losses and reinsurer caution. But now things are moderating, moving towards a softening cycle.
What's driving that shift towards softening?
The main driver is simply capital. There's a lot of it in the industry right now. Industry capital is estimated to be at a record high figures, range from maybe $620 billion up to $735 billion, depending on who you ask and what you include.
Where did all that capital come from?
Two main sources. One, existing reinsurers retained a lot of the high earnings they made during the recent hard market. Two, and perhaps more importantly, there's been massive growth in alternative capital, particularly insurance-linked securities, ILS.
That's the third-party capital we talked about R&R managing.
Exactly. That ILS market now represents a record $121 billion of capacity dedicated to reinsurance risk.
And when you have that much capital chasing a finite amount of risk,
prices have to come down, supply and demand. We've definitely passed the peak pricing levels we saw maybe a year or 18 months ago. For example, pricing for North American property reinsurance, a key market for R&R, declined by around 7% in the first half of 2025. It's a gradual shift, but we are moving towards more of a buyer's market where the insurance companies buying reinsurance have a bit more negotiating power.
But you also hear that underwriting discipline is holding up better this time compared to previous softening cycles. Reinsurers aren't just slashing prices across the board. Why is that?
I think there's still a healthy fear of frequency, particularly regarding those secondary perils, things like severe convective storms, floods, wildfires, which have caused unexpectedly large losses in recent years. Reinsurers haven't forgotten that pain. You see this reluctance most clearly in attachment points. That's the level where the reinsurance coverage kicks in. Those attachment points generally remain quite high. Reinsurers are saying, we'll cover your truly catastrophic losses, but we're less willing to cover your more frequent, smaller losses. They're pushing those back onto the primary insurers.
So it's a selective softening, not a complete free-for-all. Discipline is holding, especially at the lower layers of risk.
Largely, yes, for now.
Okay, so in this environment of moderating prices and abundant capital, how does a company like R&R continue to outperform and generate that top-tier ROE? It must come down to their competitive advantages, their moat.
Absolutely. They have several distinct advantages. Let's break them down.
Go for it. What's the first pillar of their moat?
I'd say the most foundational is their superior analytics. R&R was genuinely a pioneer in quantitative catastrophe modeling. While many competitors rely heavily on the standard, off-the-shelf models from vendors like RMS or AIR worldwide, R&R has always invested heavily in developing and maintaining its own proprietary system.
That's RMSA, right? RenaissanceRe Exposure Management System.
That's the one. And crucially, they also have their own in-house team of scientists, PhDs in meteorology, seismology, engineering, that's RenaissanceRe Risk Sciences. They're not just buying a black box model, they're constantly refining their own view of risk.
How does having RMSE give them an edge over competitors using the standard models? What can they see that others might miss?
Well, the standard vendor models are generally pretty good for common, well-understood perils. But R&R believes RMSA gives them an advantage in modeling the really complex stuff, how different perils interact, correlation risks, risks that aren't well captured by standard models, non-modeled risks, and most importantly, understanding the extreme tail events, the truly massive 1 in 100 or 1 in 250 year catastrophes. The thinking is that the public models might systematically underprice the true volatility and the potential for unexpectedly large losses in these extreme scenarios. R&R uses RMSA to identify where they think the market price is too low for the risk being taken.
So they can price tricky risks with more confidence, maybe structure innovative deals, and essentially demand better terms because they believe they understand the risk better.
That's the claim, and their track record suggests there's something to it. They aim for better than market terms because they know exactly where and why they're willing to take on certain risks that others might shy away from or misprice.
Okay, superior analytics is pillar one. What's next?
Second is their integrated capital model. We touched on this with the three legs. The seamless integration of their own strong, highly rated balance sheet with that massive capital partners platform, Driver 2, gives them incredible financial flexibility.
How does that flexibility translate into a competitive advantage?
It allows R&R to offer very large chunks of capacity limits to clients, often far exceeding what their own equity base alone could support. This makes them indispensable on large, complex reinsurance programs. They often act as the lead reinsurer.
What does being the lead mean?
The lead reinsurer is typically the one who does the most detailed analysis, helps structure the program, and sets the initial pricing and terms. Other reinsurers on the program often follow the lead's terms. Because clients value R&R's analytical rigor and the security of their balance sheet, they often want R&R in that lead position. This gives R&R significant influence over how programs are structured and priced.
Okay, analytics and the flexible capital model, what's the third advantage?
Third is simpler, but very powerful, especially after the Validus acquisition: scale and market access.
Just being big helps?
It really does in this business. R&R is now definitively one of the largest P&C reinsurers globally. This scale pretty much guarantees them a look at almost every major reinsurance program being placed anywhere in the world. Having that broad market access allows them to be incredibly selective. They can see the whole menu and choose only the risks that best fit their appetite, their models, and offer the best risk-adjusted returns. They can afford to walk away from deals that don't meet their hurdles. In a softening market, that ability to be selective is absolutely key to protecting margins.
Makes sense. Analytics, capital model, scale. Is there a fourth?
Yes, and it's that clever dual role strategy related to alternative capital that we discussed earlier.
Right, turning competitors into customers.
Exactly. That record, $121 billion in alternative capital floating around. For a purely traditional reinsurer that only uses its own balance sheet, that capital is direct competition, pushing prices down.
But for R&R?
For R&R, a significant chunk of that potentially competing capital is actually managed by them through their capital partners platform. They earn management fees and potential performance fees on the very capital that might otherwise be undercutting their traditional business.
So they profit whether capital comes from their balance sheet or from third parties. It makes their overall business model much more resilient to the ups and downs of the reinsurance pricing cycle compared to competitors who are only playing the traditional game.
Precisely. They've built a system that can thrive in both hard markets through underwriting and higher fees, and potentially navigate softer markets better by still earning fees on the abundant alternative capital. It's a really smart structural advantage.
Okay, we've built a strong case here. R&R looks like a best-in-class operator. Sophisticated model, integrated approach, resilient performance, strong competitive advantages. Now, the million-dollar question, or perhaps billion-dollar question, is the market actually recognizing all this in the stock price?
That's where things get really interesting and maybe a bit perplexing. When you value a reinsurer, the go-to metric isn't usually price to earnings, PE.
Why not PE?
Because, as we've discussed, the earnings can be incredibly volatile from quarter to quarter due to those big catastrophe losses. A huge loss one quarter can make the PE ratio look artificially high or even meaningless.
So what do analysts use instead?
The preferred metric is price to book value, PB, or often price to tangible book value. Book value represents the net assets of the company according to its balance sheet, essentially, the equity attributable to shareholders. It provides a much more stable anchor for valuation than volatile earnings.
Okay, price to book. And where does R&R currently trade on that metric?
Right now, R&R is trading at a PB ratio of approximately 1.2 times.
1.2 times book value. Is that high or low? How does it compare?
And that's where the disconnect really hits you. When you compare R&R to its main global diversified peers, companies like Munich Re, Swiss Re, maybe Arch Capital Group R&R, trades at a significant discount.
How significant?
Well, Munich Re and Swiss Re, for example, the big European giants, are currently trading around 2.3 times price to book.
Wow, 2.3x versus R&R at 1.2x. That's a massive difference, almost double.
It's a very substantial gap.
But wait, this seems counterintuitive based on what we just discussed about profitability. Basic finance theory tells us that a company generating a higher return on equity, ROE, should generally command a higher price-to-book multiple, right? Higher returns should mean the market values each dollar of book equity more highly.
Precisely. That's the theory. Yet, look at the numbers. R&R's recent operating ROE was that stellar 23.5%. That's demonstrably at the very top end of its peer group. It surpasses competitors like Arch Capital, another highly respected company, which reported a strong but lower ROE of 17.1% over a similar period.
So R&R has arguably the best profitability engine in the group, but its stock is valued at one of the lowest multiples relative to book value. That's the puzzle.
That is the puzzle. You have superior performance being awarded an inferior valuation multiple.
So what's the market's logic? Why is it ignoring R&R's top-tier ROE and seemingly penalizing the stock?
The most likely explanation, the consensus view really, is that the market is applying a significant volatility discount. Investors see R&R's history and continued significant exposure to property catastrophe risk. They remember that 148% combined ratio in the property segment in Q1 2025, even if the overall company book value held up. They worry about the potential for future large, unpredictable earnings swings from major disasters.
So they're essentially saying, yes, the average returns are great, but the ride is too bumpy, the potential for a big loss in any given quarter is too high, so we're not willing to pay a premium multiple for it.
That seems to be the dominant narrative reflected in the valuation. The market appears to be penalizing R&R for its legacy as a cat specialist, and perhaps it doesn't yet fully trust or appreciate the stabilizing impact of the newly acquired massive casualty float and the investment income it generates.
Which brings us full circle back to management's actions. That aggressive share repurchase program you mentioned earlier, that feels like a direct response to this perceived undervaluation.
It absolutely is. It's management's way of saying, we think you, the market, are wrong about the risk profile and the sustainable earnings power of this company now.
How aggressive were those buybacks again?
Over $1.4 billion worth of shares repurchased in just 3 quarters from Q4 2024 through Q2 2025. That's a huge amount of capital return in a short period.
And they funded that partly with the capital efficiencies from the Validus deal.
Correct. So management is taking capital freed up by making the business more diversified and resilient and using it to buy back stock trading at just 1.2 times book value, while the company is generating returns on equity north of 20%.
That's highly accretive for the remaining shareholders. If management is right about the intrinsic value, buying back shares at that low multiple is a great use of capital.
It's a very powerful signal. It suggests a strong conviction from management that the company's enhanced, more balanced earnings power post-Validus is not being adequately reflected in the current share price. They are quite literally betting on themselves.
Okay, we've talked a lot about the strengths, the resilience, the potential undervaluation. But any good deep dive has to rigorously examine the risks. We can't ignore the challenges R&R faces, and you highlighted they're grappling with 2 big, distinct macro challenges simultaneously.
That's right. We need to be clear-eyed about these. First, let's revisit the physical risk. Climate change and catastrophe volatility. This hasn't gone away just because they bought Validus. The scientific consensus and recent experience both point towards increasing frequency and severity of certain weather events, hurricanes intensifying faster, wildfires becoming larger and more erratic, perhaps more intense flooding. The core issue for R&R is that climate change makes relying purely on historical data to price future risk increasingly unreliable. The past is becoming a less accurate guide to the future,
which increases the inherent uncertainty and unpredictability of losses in their large property segment.
Exactly. Modeling these changing risks is a constant battle. There's a concern that the tail of the loss distribution, the probability of extremely large, unprecedented events, might be getting fatter, meaning those huge model-breaking losses could become more likely than historical data suggests.
Okay, that's the evolving physical risk in property. Then you have the very different, more societal risk impacting the now larger casualty book. Social inflation and reserving risk.
Yes, this is the other major macro headwind. And it's insidious because it's driven by human behavior, legal trends, societal attitudes, things that are much harder to quantify and predict than atmospheric physics. As we discussed, the concern is that persistent U.S. social inflation requires constant active scrutiny over those enormous long-tail loss reserves in the casualty segment. Are they setting aside enough money today for claims that will be paid out 5, 10, 15 years from now, given the trend towards larger settlements and verdicts?
And the risk is adverse development.
Precisely. If their current assumptions about future claims costs turn out to be too optimistic, they'll have to recognize that later by increasing reserves, which directly hits future earnings. Given the sheer size of their casualty reserves now, $19 billion, even a relatively small misestimation could have a material impact down the road. Confirming reserve adequacy is a perennial challenge for all casualty insurers, but especially complex in the current environment.
So this is where we see that compounded challenge you mentioned earlier. It's not just one macro risk, but two fundamentally different ones hitting their two main business segments simultaneously.
That's the crux of the enterprise risk management challenge for R&R today. They have to excel at managing the highly volatile physical risks of climate change impacting their property book, and at the same time, manage the complex, evolving legal and societal risk of social inflation impacting their casualty book.
And these risks are largely uncorrelated, right?
Yeah.
A bad hurricane season doesn't necessarily mean jury verdicts will spike that year or vice versa.
Generally, yes, they are driven by different underlying factors. But from a capital adequacy perspective, R&R needs to be prepared for the possibility, however remote, of facing extreme stress in both areas concurrently. Successfully modeling, pricing, and holding sufficient capital for the tail risk of, say, a record-breaking hurricane hitting Florida and a sudden, unexpected acceleration in U.S. tort costs, that's a formidable task.
It requires expertise across very different disciplines: meteorology and science on one hand, actuarial science, and legal trend analysis on the other.
Exactly. Maintaining excellence and foresight in both domains simultaneously is crucial.
And we shouldn't forget the more mundane but still important industry headwind, that ongoing pressure on underwriting margins from the softening market cycle due to all that capital flowing in.
Right. R&R's superior underwriting discipline, their reliance on getting those better-than-market terms, will be constantly tested as competition intensifies. They have to keep proving that their analytics and market position allow them to defend their profitability even when others might be chasing premium volume at lower prices. Hashtag tag 88. Conclusion and final thought.
Okay, let's try to synthesize all of this. Wrapping up our deep dive, the evidence seems pretty compelling, doesn't it? RenaissanceRe really does look like a best-in-class operator in the reinsurance space.
I think that's fair. They've successfully navigated a major strategic pivot with the Validus acquisition. They've transitioned from being primarily albeit very good, specialized cat reinsurer into a much more balanced, diversified company that seems built for better through-cycle performance.
And that combination of the three legs, high margin, albeit volatile, property risk, stable, high-margin fee income from the Capital Partners platform, and now significantly larger, growing investment income from the massive float, it really does create, at least structurally, what looks like an all-weather growth profile.
Yeah, the structure looks sound. And importantly, their ability to absorb that huge Q1 2025 catastrophe loss without materially damaging their book value per share really serves as powerful validation for that integrated three-legged stool model. It bent, but it didn't break.
So for you, the listener, if you're tracking R&R or maybe other companies in this space, what are the key things to watch going forward? What will determine if R&R can maintain this performance and maybe finally break free from that valuation discount?
I think there are three critical factors to keep a close eye on. First, obviously, is the severity and frequency of global catastrophe losses. That remains a huge driver for their property segment and overall volatility. How well do their models hold up against unfolding climate reality?
Okay, cat loss activity is number one.
Second is the trajectory of U.S. casualty loss cost trends, that's social inflation. Are the reserve increases and portfolio actions R&R has already taken proving sufficient? Or will we see signs of further adverse development creeping into their casualty results? Reserve adequacy is key.
Casualty loss trends and reserves, number two.
And third is management's ability to maintain underwriting discipline and defend their profit margins as the reinsurance market continues its softening trend. Can they continue to command those better terms, leverage their analytics and scale, and avoid chasing bad business just to maintain premium volume?
Discipline in a softening market, number three.
Yeah.
Those seem like the crucial signposts.
They are. How those three factors play out will likely determine whether the market eventually gets comfortable enough to assign R&R a valuation multiple that's more in line with its demonstrated profitability.
All right, let's end with a final thought. While the market currently seems fixated on R&R's historical property catastrophe exposure, applying that valuation discount, that Q1 2025 performance, where the massive investment income from the newly enlarged casualty float effectively neutralized a nearly $750 million cat loss. Well, it really does suggest that the traditional way of viewing R&R's risk profile might be outdated. So the provocative question for you to ponder is this. Does the proven structural resilience of this three-legged stool business model fundamentally change how we should value a company that remains heavily exposed to high-severity catastrophe risk? And if the answer is yes, how long might it take for the broader market to fully recognize and price in that change?